Hi everyone, Tom here. Today we'll be talking about the stock market, but it's a bit of a special episode. Obviously last night we saw non-farm payrolls come out and the numbers looked good on the surface. We'll be covering more of that on the weekend, but we thought that we would share a webinar that we did talking about stock market sectors and also talking about S&P 500 and ASX 200 from a technical analysis perspective. Hopefully everybody enjoys this episode, and if you do, make sure to subscribe and hit that like button. Welcome everybody to another FX Evolution Share Market Analysis webinar for the 3rd of July 2020. Non-farm payrolls have just happened in the US with better than expected jobs numbers. My name's Thomas Atkinson. I'm joined by Tyrone Abella. We'll be talking about the implications of that, and we'll be talking about the technical analysis today on the ASX 200, S&P 500, and several key sectors that we're looking at, along with some specific stocks and how to spot opportunity. Tyrone, how are you?
Yeah, good. Yes, it was an interesting non-farm payroll this week, wasn't it? Being a Thursday, I think it caught a few people out with the Independence Day holiday tomorrow for the US. So yeah, it's brought about some market moves, but I think we had a little bit of a reversal after it. So I know some key data came out, which we're going to touch on as well. So looking forward to getting into this one and checking it all out.
It's a very interesting balance between the fundamentals and the central bank's policies at the moment, Tyrone, but the technicals will show us the way as always. Just quick risk warning before we get started for everybody. It's important to understand that any information contained in this webinar is purely for educational purposes, and the information presented must be considered only general in nature. The information provided does not take your specific needs or circumstances into consideration, and you must look at your own personal situation and requirements before making any financial decisions, and seek independent financial advice if necessary. So Tyrone, we're going to be covering quite a few topics today. I kind of briefly summarized them, but one of those is we want to talk about the current share market trading conditions. We then want to go on and talk about a look at several market sectors and why we're looking at certain sectors and why you should be as well during these periods of the crisis. And of course, how to spot potential opportunity using technical analysis from the sector to the stocks. And then at the end, we'll be talking about our Q&A with obviously the members of the room today. So if you have questions, please feel free to ask them throughout this webinar, and we'll do our best to answer them at the end. We usually have about a 10-minute kind of process where we go through the questions at the end. So recognizing trends is one of the most important things, isn't it, Tyrone, when it comes to looking at the stock market and looking at specific stocks. Now, we all know that in general, if you buy a quality company at a good price, over time, usually quality companies go up. So the trend is usually biased towards, I guess, the upside. However, in recent times, we've seen some pretty high volatile markets, with markets moving up and markets moving down. And the importance is being able to recognize them from a price action standpoint, from recognizing the troughs and the peaks and the higher troughs, and seeing when a change of trend occurs. We'll be going into the charts a little bit more, but Ty, is trend your friend or not? What do you think?
Trend is definitely your friend, and look, obviously when we're buying shares, we're not looking at shorting them, because obviously that's a far more difficult process than buying them. But it's very, very important to understand how they do go down and how a downtrend does actually work, because that's what you want to be avoiding, obviously, when you are entering a position. So even though you're not technically potentially trading off the downtrend, what you are definitely doing is actually identifying that a downtrend is in play, so you know the good places to actually start to buy when it does break through. It's a very, very important process to understand when a market is falling, because a lot of people just jump in and buy stock or shares whenever they see a bit of a pullback. But if you know that a market's in a downtrend, it's really, really important, especially if you're selling options and doing things like that. So we'll definitely be covering both, but a trend is definitely your friend. It's never been any different. In all our experience, you're always going to be better off trading in the direction of the trend.
Yeah, it really helps you to get advantage in terms of being able to recognize that trend. So one of the ways we can do that from a price action standpoint is to see a peak or a price in the market where the market's reached a high, then it reaches a trough, and then it reaches a lower peak. It fails to make a new high, and basically what then happens is the market breaks through that previous trough, so it breaks through that low and forms a new lower trough. We'll be looking at that in the actual market in only a few minutes, but that's the way that we want to analyze it. We want to see a change of trend from the price action. Let the price action and the market tell you the way. So speaking about the market, let's actually go and have a look at the two major stock markets, the ASX 200 and the S&P 500 from a technical analysis standpoint after the non-farm payrolls last night. So here we have the ASX 200 in terms of the current price and what has happened over the last couple of months. So we had that very aggressive sell-off tie coming through the crisis period, and the ASX 200 certainly bore a lot of the brunt in terms of what was happening there. But what has happened since then has been a pretty nice increase in price. And then we saw on the charts actually incredible technical levels. So one of those was the 5,500 key psychological zone. What you'll often notice in stock markets, and it's the ASX 200 or the S&P 500, really doesn't matter, they gravitate to psychological levels. And that's because of the nature of the participants in the market. If you have people in the market and they're looking at taking profit, they often like to take profit at key levels. They might say, okay, I want to take key profit at 6,000. I want to take key profit at 5,500. It's built into our human psychology to do that. And that's why technical analysis works so well, because really in the charts, when you're analyzing them, you're looking at the human psychology. You're looking at the dynamic between the buyers and the sellers. So here we have that 5,500 level that acted as resistance, Tyrone. And then as it broke through that resistance, we see it came up and then it came back down. It tested that level, which acted as support. And that's something we call role reversal. We'll be going through that in this webinar. But it's very, very important to understand that concept, because this was a key break. And you can see that slingshot effect that happened after that with that massive move up. And then, of course, now where we are at in terms of price. So, Ty, I mean, what do you think about the 5,500? It's a pretty great level, wasn't it?
It was a great level, and look, yeah, it's quite often it's the history that dictates the future and the present, and we know that 5,500 is a very, very solid level, well before this coronavirus crisis. So it stood to reason that when a market is uncertain, it often does gravitate to these key levels that have provided a support or resistance level in the past. And yeah, the 5,500 is a very, very strong support level for many, many months throughout the periods between 2009 and obviously now. So it came as no surprise, but this has been that reload zone at the role reversal area was just a golden role reversal. I can't wait to get into the role reversal so we can actually explain how that works, because it gave everybody a really good opportunity to get into the shares that they wanted to. Because at the end of the day, we must remember that the ASX 200 is basically dictating what the majority of the shares are going to do. It's not an absolute representation, but it certainly gives us a very, very good indication of what the top 200 companies are doing. So it gives you an opportunity, even if it's not the ASX 200 that you're buying, to actually get into the shares that you think are going to be doing the same thing as it. So it was a very good re-entry zone.
So here we've dialed into the 1 hour chart on the XGO. So if you're a trader or somebody that wants to recognize opportunities, we've actually seen a few opportunities over the last week. So I've drawn up two horizontal lines here, and I've got the horizontal resistance at the 6,000 level, and I've got the horizontal support at the 57, kind of 50, 57, 60 area. And these have both acted as great buy opportunities and also confirmation opportunities. So what we've seen is the 57.60 area has acted as really nice support buying over the last couple of weeks. I mean, Tyrone and I have definitely been looking at this level. We even have kind of highlight zones where you actually have some amazing kind of price action based candles. You've even got this nice bullish hammer that's come off the zone initially. And then you've got this big engulfing candle, and you've got another nice engulfing candle. And I think over here on the right was actually the best opportunity we've seen. This particular one, where we had the engulfing candle coming off the base, is showing a strength. But on top of that strength, we're getting an opportunity to buy it where the S&P 500 was also at key support that we'll talk about. When that level broke last night off the non-farm payrolls numbers, effectively it's going to give us the sign that we're seeing further bullish momentum, we're seeing further strength in the market. And now what we'd expect, Ty, is we'd expect a bit of a pullback probably for it to come down and for it to test that 6,000 level. So for the 6,000 level to become where it was resistance, will now act as support. And we'd probably expect some kind of bounce technically up to potentially the 6160 area, where again, the previous market high will act as resistance. So this has been a pretty good buying opportunity, but let's have a look at the S&P 500, as at the end of the day, really the S&P 500 will dictate to the Australian market to a degree what is going to happen. So here we have the S&P 500, and I think this is where we need to talk a little bit about the non-farms job report last night. So the job report came in pretty strong, and the stock market, at least initially, reacted quite bullishly towards this number. And why not? Obviously, the jobs number is better, unemployment's coming down, perceived opening of the economy is looking better as well. But the charts are telling us a different story, and this is why sometimes we see that the charts give us the direction even without understanding necessarily the fundamentals that are at play. So if we actually zoom in here, what we'll notice is that the S&P 500 is really in what we call a technical channel right now. We have a strong resistance level here at the 316 or 3,160, and we have a really strong support at the key psychological zone of 3,000 or 300 here. These levels are trapping the market. The market is in a range, and last night, what we saw is that the Federal Reserve has continued to decrease its balance sheet in terms of its asset balances in the stock market. And what this is showing is they're trying to kind of take away some of the stimulus from what they did to stabilize the markets. They're probably pretty comfortable with where the markets are at. They're comfortable that they're doing the right thing, and the charts are showing this. So you might have just looked at the fundamentals number, but look at that weakness we saw coming into the close. Tyron, what do you think of this channel? It's pretty good, isn't it?
It is pretty good, and it doesn't surprise me really that a market that is obviously confused because we're getting numbers that I guess unprecedented given the jobs numbers and everything else, with the uncertainty of the opening of the country and all of the extra virus infections that they're getting. We really don't know what's going on, and when that happens, it doesn't surprise me that a market finds a consolidation zone. Now, it's decided that 3,000 and say 3,150 to 3,160 is going to be that channel. It's certainly been strong in that period. Now, it's a good thing for us, I think, because although it looks like it's a confused market, when a market is in the channel, it gives us trading opportunities. And I think that when it is consolidated like it has here, and it's basically found its support and its resistance, it gives traders an opportunity to actually trade within that channel. So not necessarily for the longer term, because with the longer term breakouts, we have to wait for that to actually break out. But it does give us opportunities to pick up shares that we might have been wanting to top up on at the bottoms of the channel, or when the channel is starting to gravitate to the top. So it does give us opportunities. So it's probably a good thing that it's going to stay in here, because if it was starting to break up above there without really having a vaccine or having certainty in the market, it provides what we probably term as a bit of a false market, and no one wants a false market because it gives us too much uncertainty.
So let's talk about some of the basic technicals we're seeing here. So we've got the 200 moving average, which will act as dynamic support for the market at the same time as we have the 50 moving average at the same point, again, dynamic support. We talk about those key psychological levels before on the ASX, where we're talking about the 5,500 and the 6,000, and the same thing happens on the S&P 500. If the market was to come down like this arrow is saying, where the resistance up here in the channel will act as resistance and the market comes down, at the 3,000 key psychological support, we're going to have a 200 moving average, a 50 moving average, and also the 3,000 psychological support, as well as the previous price action support. So there's going to be a lot of buying pressure coming into the market at that level, and we've seen that recently. And this will be the key zone for us to look at. Whenever we're doing analysis on the ASX 200, we also need to go and look at the S&P 500, because that is the one where if it breaks a key zone, if the S&P 500 gets above this 3150, 3160, what does that mean for the ASX 200? Probably further bullish momentum. You want to look for opportunities in the stocks, look for opportunities in the indexes. These are the things that we do want to do. If it breaks below this zone, then we want to look for potentially opportunities maybe for long-term buys down here at 2,800. That's the kind of zone that you expect. Generally with things like channels, we see the movement of the market in line with the channel distance. Now, if a breakout does occur, it usually goes around that distance. If you take that distance, you'll notice it often goes the same point, and that would be back into the 2800. So it's very interesting and a key observation that technical analysts want to do. So let's jump straight back into the presentation and talk about horizontal support and horizontal resistance a little bit more. So here we're drawing up horizontal support. We notice that the market is finding support, and think of this like that 3000 level on the S&P 500. The market has already come down and shown us that it respects that level and that the market participants and buyers are aggressively purchasing off this zone. And that's the importance of price action. It's about understanding the market dynamics and understanding that the participants want to buy at this level. They see value in this level. So when we see that level reached, what do we expect it to happen? We expect a bounce, of course, and the market to go up. So support, you're looking for buying support. You're looking for a level where people see value. In the real market, it might look something like this, and that's very similar to what we're seeing actually on that S&P 500. A high, it's come down and it's tested that level multiple times. And until that level is broken and confirmed and closed below, it continues to remain a level of buying pressure. Here are the A, B, C, and D. Now, there's no limit to how many there can be. There could be 20 different support levels at the same point. We've seen that over time in the Australian stock market, where certain shares have actually traded within a range that we'll learn about in a second for a very, very long time. In fact, over 12 to 18 months. From a resistance standpoint, similar to that 3150, 3160 on the S&P 500, we have a key level where the market has reached a resistance. People have taken profit. Traders have said, okay, this is already too high. We believe that that's fair value or above fair value. We're going to take our profit out and we're going to look for the market to, of course, then bounce down or move down. So that's at 3160 that we were seeing on the S&P 500. When you bring together your key resistance and you bring together your key support, what you end up doing is you end up creating a combination, or as we like to call it, a channel pattern. So channel patterns are amazing abilities to trade because you get to trade both sides of the channel where you can buy the bottom, sell the top, and then of course you can also look for maybe just close or breakouts from this strategy where if it breaks, let's say to the upside where the market comes back up and breaks out, we were talking about it before, it goes the distance of this channel and that channel then can be extrapolated out. So basically we'll say, okay, that's our expectation. It gives us an area to take our profit or to exit potentially some of our positions. Tyrone, you love channels, I know that. What are your thoughts on this?
Well, I think channels provide us with such a good opportunity to enter a market that we've missed. I think that's probably the biggest point of them, that you've got a very clear place where either one, you can take profit, two, where you can enter, and probably just as importantly, a good place to put your stop losses when you need to do your risk management. Like, you know, that you're obviously going to put them behind the bottom of the channel because it would be pointless putting them in the middle of the channel because there's a very good chance that they're going to get hit. So you really need to adjust your position size to make sure that you're able to put a stop loss within your risk parameters below an area where you don't think the market's going to go. Because I mean, that's the whole point of a stop loss. If we were putting it in the middle of the channel, then yeah, you're asking for it to be basically hit. So you might as well take the trade out straight away. So I just love them because I think they give us really, really good opportunities. And also when you do break down the different time frames and you go, like if you've got a channel, say on a weekly or on a daily chart, you can go into the smaller time frames like the 4 hour and the 1 hour, and you get your key entry points. So you can basically see the trends happening inside the channel and basically enter like you would in a normal trending market. So although you're trading a sideways channeling market, you still got the ability to trade a trend-like strategy to actually get in at really good levels. And I think that's really important.
On to your point there about the daily, let's say this was a daily channel. If we saw the market coming down and then we broke this down to a 1 hour, what we might be able to see is potentially a change of trend where we see that trough, we see a peak, and then we see a higher trough, and then that peak is broken. And this gives us a technical change of trend. Now, if we saw that technical change of trend, let's say on a 4 hour chart or a 1 hour chart, and we were looking at a channel on a daily, what is this telling us about the market participants? Well, it's showing us the strength of their conviction towards that support. It's showing us that they're committed to that level, they're prepared to buy that level, and they want or they see value here. And when that break of the peak happens, a lot of buying pressure will be coming into the market. And that's a great level as a technical analyst to actually get into a stock or a share. In this case, we're talking about quite a lot of things right now, Ty. We're in a difficult time for some people to invest. Obviously, we're seeing a crisis that's unprecedented, and with that comes unprecedented differences in different sectors in the stock market or share market. Basically, we're seeing market cycles that are a little bit out or a little bit different from the norm. So usually we'd expect something like this to happen, where we would see as the market contracts and the actual shares go down, we'd see defensive shares come up. So we'd see things like utilities, consumer staples, and healthcare do quite well. And then coming out of a crisis, we usually see things like technology, materials, transportation, things with infrastructure. They often do quite well due to government builds, etc. So let's now take a look at some different sectors and how you can actually dial into the technical analysis of different sectors in the share market. We'll have a look at that right now. So the first one we'll start with is going to be XUJ, which is the utilities sector. So utilities sector is historically quite defensive during times like this, and it certainly has picked back up from its lows, of course, in March. But I'm starting to see a very interesting pattern here, Ty, and we were talking about this one just before. We were talking about a channeling pattern where the market is effectively stuck in a range. And we've seen incredible buying pressure around this 7,500, and we've seen some selling pressure coming in at around that 8,000 on this particular sector. So the utility sector obviously covers all the utilities on the Australian Stock Exchange in terms of the big ones. And what we're doing is we're trying to dial in and see if there's an opportunity as a whole for the sector, and then we can look at specific shares in that sector and potentially take advantage of them. So utility sector is on the move in terms of up, but whenever it's been getting down to this 7,500 level, there's been strong buying pressure, hasn't there, Ty?
There has, and it's providing a really, really nice trading channel for the very reasons we talked about earlier. Now, like Thomas said, this is representing obviously the most important utility companies in our market. So the reason why we're looking at the sector index first is because it's going to give us a little bit of a, not so much a bias, but a bit of an idea as to what's actually happening overall in the sector. And then we'll be able to actually dial down and have a look at the companies individually inside this sector to see if they're actually performing in line with the sector index itself, which is really important because that's where you identify value or undervalued companies. So you can see here, obviously, that's a role reversal. It'll make a lot more sense when we look at the role reversal zones in the coming slides, because you'll be able to revert back to this and see why this makes so much sense. But it's a really important aspect of why there was resistance at around that 8,000, because it was previous support that has now turned into resistance. So it's a very, very clear line and very real reason why that 8,000 is going to be a difficult part for this to break.
Yeah, the 8,000 is certainly going to be quite tough for the market to break through. So we'll go and have a look at a specific utility stock in a minute. But before we do that, let's have a look at the financial sector, because I think the financial sector is seeing some considerable kind of value in it. And we are seeing some little breakouts happening here, Ty. So very strong accumulation over here during the crisis period. We had a massive sell-off because, of course, lowering of interest rates is not really beneficial to financial companies. It kind of doesn't really strengthen their profits. It weakens their profits a little bit. And we saw accumulation down the bottom here where the market was in a tight trading channel range. It broke out, and look at the explosive move that happened afterwards. So I wanted to just quickly talk about this because we have different opportunities right now, but I want to just say there's a nice bullish hammer here after the explosive move, and this is a buying kind of signal that you see often in the market, and we'll be talking about that one, but also what's happened recently. So our resistance over here has been broken through. So the resistance has been broken through, and the market has closed above this zone. And that's important because then when we start looking at the specific financial shares, we might see similar price action on these. Again, we'll talk about role reversal in just a minute, but the market will be coming back down. We would expect some weakness here Notice how it stops just before the 5,000. Again, that psychological zone or level, and the market would probably sell off, come back down, and then this 20 moving average would actually come in at the same time. So we'd see resistance over here, which would then act as support. And at the same time, you'd have that dynamic support coming in from the 20 moving average. So all of this makes sense, and it certainly will make sense when we look at a specific share in just a few moments' time. Ty, I mean, what do you think about this? It's pretty nice base, I think.
It's setting up to be a really nice trade, actually, and it's amazing how often the indices on these particular ones actually do line up to what the shares are actually saying. But like I said, when you do your analysis on the indices, and we do always advise that you do that first before you actually buy an individual share, because you're getting an overall view of that sector, and that really lets you compare shares for shares on the basis of what the actual sector is doing. It's really, really important because, for instance, if we're looking at the financial sector and we're saying, okay, are we going to are we going to buy NAB, ANZ, Westpac or CBA? Let's just keep it to the big four as a guide. We know what the sector is telling us, so we know what the expectation is of those shares. So is one underperforming the other? If you're not really set on which one, you're always going to go for the one that's probably the most undervalued, because that's the one that's going to present the best reward if it does actually play out to what the sector is basically indicating it's going to do. So that's why sector analysis is actually so important before you actually place a trade on a share in that sector.
So speaking of sectors, we're going to move on now to the materials sector. And I want to mention this one because in that chart before, when we're talking about recovery, materials is one of the key areas that often people look at. And obviously the stock market has already done that. The shares have moved up in the materials sector. In terms of what we've seen recently, we've seen that 12,000 kind of 800 acting as support on the materials sector. We've seen big breaks happen and been explosive, and a pretty nice recovery. So this means that shares like Rio and of course BHP are looking at potential longer term growth. Remember, if governments go into infrastructure builds, what do? They build rail, they build roads, they build several key infrastructure projects around their main cities. They do this, and it requires, one of the key ingredients is iron ore. It's not just the Australian government that's going to be doing this. It's the Chinese government, it's the American government, it's the British government. It doesn't matter. They're all going to have to do it because they need to construct and they need to create jobs. As part of that, you see iron ore usually spike, and that has been what's happened recently, but there's usually a big cycle in this. So that means that you can be looking at quality companies for an opportunity over a cyclical event that takes multiple years. Remember, when you're talking about construction and massive infrastructure projects, you're talking about multi-year level approach, multi-years worth of these infrastructure projects coming in. So one of the things I noticed straight away here before we go into the shares themselves is that it has had a little bit of a breakout here, similar to the others with the resistance. We have a very close previous resistance over here though, which quickly rejected. But we have this zone over here, this 12,800, and this is going to line up really nicely with one of the shares we'll talk about soon, where basically if the market was to come down into this zone, we would see dynamic support from the 200 moving average, we'd see dynamic support from the 50 moving average, and all of those would be sitting here at the same point as previous support acts as support again. So that's price action, and that's why you want to set alerts for these levels. It's always worthwhile. You might not see it now, but playing the market or being invested in the market is like chess. You want to be thinking a few steps ahead, if possible, before you get into it. So that's a really important point. And I think the materials sector is giving us that opportunity. So one of the things that we get asked about all the time, and I think that a lot of traders and investors struggle with, is FOMO, Ty. They hear about something or they hear about somebody making a huge amount of money in a particular share, and then they feel the fear of missing out. They feel that FOMO, and they go through the 14 stages of trading or investing psychology. And I think it's just, this is a great one because it has these emoticons. I know you and I laugh about it all the time, but it's very true. We've trained a lot of people. We've talked about this a lot over the years, and everyone goes through this at some stage, don't they?
They do, and I think everybody probably here can probably relate to several of these emojis at some point in their trading lifespan. The idea, of course, is to try and eliminate these from your trading, because really, at the end of the day, trading or the best trading is going to be an emotionless process that actually lets you do what you need to do, almost like a robot. Now, a robot doesn't have emotions. So you really need to trade like a robot and be very, very systematic and specific in what you're trying to do. So as much as we can laugh about these 14 emojis, what we actually want to do is remove them all from our trading. So it's one thing we have to keep in mind.
Another thing we need to keep in mind is that the market is generally going to go up on quality stocks over time. And that means that from the chart patterns trends, we need to be looking at things like inverse head and shoulders patterns, double bottoms, ascending triangles, and flags. We won't be going any more into these today, but it's important to understand these chart patterns, because when you do, you get an extra element of confirmation, and therefore your psychology will be better because you know that you have the chart pattern helping you out. And these are some of the great reversal chart patterns, specifically double bottoms and inverse head and shoulders, from looking at the charts. Two of the best there. Now, we've been talking a lot about role reversal, so let's just quickly discuss role reversal from a point where resistance becomes support and the uptrend, and then of course the opposite way. So basically we talked about that resistance and support before. We talked about how resistance is a point where the market participants are thinking that they want to sell the market or they want to get out and take their profits. And at this level, the resistance is reached. And then, of course, when that is broken and the market participants believe there's more value in this particular share, they push it up. And when they push it up and close above, that means that the confirmation of the next level or the next move is most likely to occur. Now, from a conservative standpoint, one of the best things a technical analyst can do is that they can recognize this breakout, and then they can recognize where the resistance is going to act as support. And once they've done that, they can buy or get the opportunity here to get into the market. And that is what you want to be doing as a technical analyst. From the sell side, what we're looking at is where support is basically going to act as resistance. So similar thing, it's just the opposite method, where the support is broken through, meaning that there's further weakness in that share or that stock indice, and then that acts as resistance and the market moves down. How does it look in the real market? Something like this. Very similar, actually, to in terms of in a downward market, this is the kind of thing how you can put it together. Usually the downward market will swing low and then swing high. Remember those troughs and peaks we were talking about? When a trough is broken through, often the market will try to reverse and it will actually come back up and test that previous support as resistance. So it's pretty cool to see that. And that's the type of thing that you will see happen time and time again in the market, and it gives you that opportunity. Quick thing with best candles. We talk about this one all the time on these webinars. We talk about hammer candles, which can also be known as the Dragonfly Doji if they close at the same price as they open. Very bullish kind of candle. We saw some in some of the sectors that we're talking about in terms of the key points. And in a downtrend, one of the best kind of candlesticks is the shooting star or the gravestone doji. These are both great setups and great kind of reversal signals. So now that we've done that, let's have a look at some of the charts and some of the key shares that we were talking about before in terms of the sectors. Well, the first one we'll just quickly gloss over is AGL. So AGL has presented great buying opportunities down here at this 16.20, 16.30 zone. And then it's presented a great kind of take profit opportunity at the key psychological of 18. Now, remember, we were talking about the utility sector before, and AGL is one of those, and it obviously is not doing as well as some of the other utilities, but what it is doing is it's presenting a great technical channel and a great technical signal. And we can start to set alerts for a whole bunch of different things here. Number one, we could see that the market would get up to $18 and see whether it acts as resistance and the market comes back down, potentially gives us another buying opportunity. The other thing we could do is if it did break through this $18, we could be looking for the role reversal where the previous resistance will act as support. And remember, the great thing about recognizing a channel is it usually goes the distance of the range. So you'll be having a very nice opportunity here on AGL potentially from a technical analysis standpoint. I mean, Ty, this is a great one, isn't it?
It is, and it really does give us a couple of set plans, really. Like if it does channel down again and comes back down to that sort of 1650 area, obviously it provides a really good buying opportunity to add to this, or either add to your existing positions or buy a new position. But of course, if it does break the channel, now look, channels do inevitably do eventually break. We can't predict when they're going to, but when they do, it does provide another really good opportunity. It really brings in that role reversal that we just saw play out. Now, role reversal is a very prominent thing in the market. So if you haven't heard of it, do some research on it. We talk about it every single week because it really does work. And what it does, it will provide you an exceptional opportunity to actually enter the trade if you haven't already got in there, or even add to your position. Because once it does break out of the channel and comes back and tests it from the top, what it's doing is giving you confirmation that the channel has been broken, and it's giving you the reload zone, which is a really, really important aspect. Add to that one of those chart patterns that we were talking about, or a particular candle pattern that is bullish, and voila, you've got a fantastic opportunity to take this long. And the next real resistance is quite a bit away. You've got several dollars of upward strength on this one. So, and knowing that the sector has got some upward movement in it as well, it certainly helps add a case to potentially buy this at those levels that we're talking about.
Yeah, so AGL was a nice one from the utility sector. Onto the financial sector, we have one of the bigger banks, which is Commonwealth Bank. And this particular one is having a bit of a breakout at the moment. We saw that strong accumulation down here around the 58, 56, where at the kind of peak of the crisis, and even presented quite good value even after that, until people realized there was strong buying pressure. Now, we had a condensed range, but we had pretty decent volumes down here. And then it broke out with strong volume buying pressure and hasn't really come down back down to these levels yet, where we haven't seen CBA come to $60 again. But what we have seen is that role reversal acting, where previous resistance over here around this 60 kind of 6 area is acting as support. And the market has broken out above 70, the key psychological zone, and reached the previous resistance. So if you were on a smaller time frame looking at, like, let's say an hour chart, then you could have potentially recognized this breakout opportunity, gotten involved in buying this potential share, and then looked at taking the profit off at around this, just before the 72. I'll just bring up just before, because that's the thing that you want to do. If you recognize there's a psychological zone like $72, usually consider taking your profit slightly earlier than that. You do that because everyone else has buy levels or sell levels at the round numbers. When you look at volume in the market in the NAB platform, you'll notice that you have a huge amount of selling at or buying at the round numbers, at the double zeros. So consider always taking profit a little bit earlier than that. Nice breakout, Ty. Not much else to say about this. We had a nice cross of the moving averages before the breakout. That's also a great signal, isn't it?
It is, yeah, and look, it has found support on the 20 on the daily chart as well, which is obviously really important. The daily chart is the one that gives us the most amount of information. As a rule, you found that they're giving us the support, the dynamic support that we're always looking for, and it's been a really good trade, this one, and it's working very well with what the sector index was actually telling us as well. So it's a good example of what we were talking about, and certainly one to watch and set alerts for.
Yeah, I think I'll be setting alerts for the role reversal here, Ty. The $70 broke out of the key psychological zone, the 20, as you mentioned, on the daily, and then at the same time, all of the 20 will be acting as dynamic support as the role reversal does its thing. So CBA, another one to watch. In terms of setting alerts as well, remember the materials sector, we had a pullback zone with two key moving averages, the 200 and the 50. Well, what do you know? Rio, one of the largest Australian iron ore stocks, is showing a very similar level. What a great buy zone, $92 flat. We have a 50 or 92.50 pretty much here. We have a 50 moving average, a 200 simple moving average, previous resistance acting as support, and we're starting to see a little bit of weakness. I think it's a bit of a heated sector right now. Is there a great buying opportunity? Yes. Is this a great stock or share? Yes, it is. But the biggest problem with it is that it moved very aggressively up, and now we're seeing a bit of a cool off. And this is often what you do see, which gives patient people a bit of an opportunity to get into the shares. So basically this 92.50 is going to act as dynamic support, and that's certainly something to set alerts for. Another thing I just want to quickly mention is Fibonacci retracements. So we talk about these all the time. We won't go into them too much in this webinar, but we do cover them quite a lot in our webinars. And that is that we want to be able to draw Fibonacci's and understand them. They're great with role reversal. And this is just a quick little chart just showing you how you would draw it. You draw it from the swing low to the swing high, and you drag and drop it onto your charts. You can do that in your trading platform. And then you'll have some rules about things, but they work really well with the role reversal, where the previous resistance will act as support, and at the same time you often see on the charts the actual Fibonacci levels showing this. So the Fibonacci levels will literally show that. If we go back to that Rio option here, and then we say, okay, well, with Rio, what's been happening on that recently? Well, if we draw the swing high to the swing low, what you'll notice is, we can draw it up to here, by the way, but I'll bring it across so it looks a bit cleaner, is that you're going to have two ranges acting as dynamic support. So you're going to have one sitting at about this $94 on the 38.2 fib, and then the better fib probably here is the 50 fib, which is just under 92. So you might want to be buying in this range. I think this 93, 92.50 makes sense from a technical analysis standpoint, but you do have the nice dynamic support, or the support here of the Fibonacci 50 just under at around that role reversal zone. So important to draw that, and really great tool. Fibonacci's work, and they work because they've been used for so long in the stock markets.
Especially when they overlay with previous support and resistance. When they're part of an actual trade plan, they're fantastic. They give you that extra confirmation that you really need to actually place a trade.
When it comes to trading the markets, you always want to have really solid risk market strategies. And you also want to have this if you're investing in the market. You want to think, what is my potential opportunity and what is my risk? So we talk about 1-to-1, 1 or 2-to-1, or 1-to-2 risk rewards, and 1-to-3. If you're trading the bottom of a channel, like we saw before, you might only have to have a very small stop loss for a potentially good reward. It could be 3 or 4 or 5-to-1 risk reward ratio. Very important to consider that. You don't want to be looking at maybe putting $1,000 at risk and then only being able to make $100. That doesn't make sense. You need to be able to make at least a 1 for your risk to your reward, ideally over the long term. I will bring up a quick quote here because I think it's really relevant to the current crisis, and that is, be fearful when others are greedy, be greedy when others are fearful. Many people have heard this. Obviously, it's a Warren Buffett quote. And it's really important to understand that when people are sometimes scared of particular sectors, or they're scared of the general market, always think about it from the perspective of, you buy quality and you do the technical analysis and you make sure that you're buying a key great price zone, usually you'll do okay. So Tyrone, we've had some questions during this webinar, and I believe we want to answer some of these right now. One is from Jess, and Jess asks, how do we avoid breakouts in terms of breakout failures during trading shares? And it's a great question. Basically, if we have a breakout in a share, I'm actually going to look at this in the charts. How do we avoid it? Well, what the easiest and simple, I think, answer is going to be take the conservative entry. Here's a great opportunity. So we had here Rio, and it broke out, gapped above. Now, a lot of people would say buy at the close up here. But Tyrone, what should we really be doing?
What we should be doing in that situation is avoiding the jumping on a moving train, and actually wait for the train to pull up at the next station, which is obviously the role reversal that we always talk about. Sometimes it's not going to happen. Okay, sometimes the express trains just keep going, but look, more times than not, they will come back for you and get you back in on that zone. And if you wait and you actually get, not only are you going to get a better price, because obviously it's going to come back down and give you a better price point because you're buying it at a cheaper level, but you've also got that confirmation that that break is going to be probably more sustained. When you do just randomly enter on those breaks and try and jump on that moving train, that's quite often what happens when it does reverse and really punishes you. That really shows what breakouts can actually do. We call them a fake out, really. That's what they sometimes are. So the conservative entry is definitely waiting for the retest, because at the worst case, even if it is a fake out at that point, if you're in, you're not going to be in as deeply as you were if you had bought at the top of the initial breakout. So your limited risk is going to be obviously less because you've bought at a cheaper price, but you've got a far more confirmation that the market is going to respect that zone now. And look, occasionally, again, you're going to miss them. Sometimes you are going to miss a few of them, but it's better to wait. Sustained good trading is going to make you more money in the long run than just trying to jump on board every one that goes. Sometimes they just don't come back, and they do keep going. But we find that the ones that come back and retest it are often a better, more sustained move, because it does make sense to actually take those entries on the retest of that level.
Yeah, it certainly does. Another question we've got here from Jenny. Oh, no, sorry, this one's from Sam. Basically, Sam asks, where would we place stop loss levels in terms of price action? It's a great question. So here we have the CBA example, and the reason I bring this up is because it has a very clear stop loss level. So let's say we were buying it here. If we were buying it here, where would we place the stop loss? We'd want to be placing it underneath the previous lows of this range. So when we dialed this into the 1 hour, we noticed that there was a very strong support coming in around the 67, 66. Let the market tell you and the price action tell you where you'd like to place your stop loss. So you'd want to put it underneath this zone here, and you would do so because it would give the trade or the investment the longest possible opportunity to do the right thing and to move into your direction. So that would be down here for sure.
Yeah, and what you're adding there as well, you're also giving yourself a lot more protection, because the more things that you can put in between your entry point and your stop loss, the more chance you've got of that trade actually holding up. Now, in this example, we've got a very good role reversal zone. We've got a 20 moving average protecting your entry. The more things that you can put in between your entry point and your stop loss, the better it's protected. Okay, so it really makes a big difference. If it's going to stop price at the end of the day, it's those dynamic support levels and previous role reversal points that are going to halt price and stop it from coming down and giving it a chance to not hit your stop loss. So try and put as many things as possible between it.
So the last question we've got here is from Jenny Tai, and basically it's just in regards to last night's news about non-farms. Basically, the Fed keeps dropping its balance sheet. Do you think this will be a recurring trend? I do. My personal opinion is that it will continue to do this. I think the Fed is quite happy with where the market is right now. Basically, they are content with what they've done, but they need to be very careful. They're starting to be held a little bit accountable for some of their actions. I mean, remember, they printed trillions of dollars and put them into assets. So I think they're going to manipulate and try to scale back a little bit if they can in terms of the general market, and they'll do that as they see better news. They saw last night some good jobs numbers. Obviously, they've been seeing these data and their data showing that. But if you ever hear Fed Powell and what he says, he always says it's going to be a long kind of time. We're not going to just see this crisis disappear tomorrow. It's going to take a long time for the American economy and therefore the world economy to actually come back. Very important and very good point. But I do think we'll see the balance sheet slowly decrease as long as the economic news continues to be relatively positive.
I think they're very happy with what they've been able to achieve so far, because they've been able to. What the Fed don't want the market at 4,000. Let's get that straight. Like, the Fed's not trying to get the market to 4,000. What they wanted to do was stabilize it and stop it going to 2,000. And I think they've effectively done that. And I think the results show over the last probably month, especially, that we've been caught in this range. And I think the Fed would be quite happy to see this market floating, the S&P 500 I'm referring to, in a range of that sort of 3,000 to maybe 3,200. I think they'd be quite happy with that. And if they can slowly reduce their balance sheet and basically adjust on the fly and keep the market stabilized in that zone, I think they'll be quite happy with the job that they've done. So yeah, certainly one to watch. But yeah, it's going to be a very interesting time moving forward.
Well, thank you everybody for attending today's webinar. We hope that it was informative to you. I think everyone can see the benefit of looking at market sectors and then breaking down sectors, breaking down opportunities from the top down. We always talk about top-down approach here, and then going and looking for share opportunities. There certainly is great opportunities right now, and I think the technical analysis gives you some of the best reasons to be in a share, and on top of that, some of the best key buy zones. If you bring that together with your fundamental analysis, it is a match made in heaven, Tyrone, isn't it?
It is. It definitely is. All right. Thanks again, everyone, for joining us. Keep an eye out for the invitations for our next webinar on the stock market analysis, and we hope to see you there.
Thank you very much. See everybody.
So I hope everybody enjoyed that webinar, enjoyed our discussion, and found it helpful and valuable. If you did and you want to subscribe to more of our free webinars and events that we provide, then why not check out the link down below and sign up for our free trading cheat sheet with some of the best technical analysis patterns around. See everybody in the next video. Bye.